Hello, hi, it's Adil bringing you a review of the FTSE 100 and where we're going in the following week. It's commencing Monday, 18th of August 2014. I'm bringing you an internet market analysis perspective. I've just done a US markets video, and that obviously has a bearing on where the FTSE will go. As you all know, US markets dictate, especially the relationship with the S&P 500 and the Dow and the FTSE 100. So just bear that in mind. Okay, so have a look at that video as well. Okay, so the US video overall was bearish and forecasting a down move. Therefore, the FTSE itself, based on that premise, so based on that analysis, will also be heading south as well. Okay, so let's see what we can discuss here. Okay, so as we all know, geopolitics. I'm not going to go over that again. Geopolitics, obviously, with regards to sell-off on Friday. And obviously, as you can see, the FTSE 100 putting in a topping tail that was based on geopolitics. Obviously held a 61 to 75% fib resistance, and obviously put in a lower high. So we are in a downtrend. We're in a series of lower lows and lower highs, and obviously Russian sanctions are obviously hurting growth prospects going forward. And with regards to emerging markets, obviously under pressure as well. The MICEX has had a dead cat bounce, and the Russian market, or should I say the Turkish market, has had a dead cat bounce as well post-election. So you've had two indices, or emerging market indices, obviously rally going into last week itself. Obviously, like I said, we discussed obviously going with regards to that, so just bear that in mind. Okay, so that will be very, very important. Okay, going into next week. So dead cat bounce is there. If it's a dead cat bounce, obviously we all know it's heading south the next time. So just bear that in mind. Okay, so just bring up my chart of the emerging markets, and after we always tend to observe Reuters icon. Okay, so basically this is where we are. So topping tail based on that. Okay, so not only that, we also had Mr. Carney this week. I did explain last week's video that obviously we expect the markets to go higher on a weaker sterling, and that's exactly what's happened. The market's rallying on a weaker sterling, given the fact that he's dovish. Okay, sterling has actually absolutely been clobbered. Okay, look at that move there from 1.7 all the way down to 1.6. 1.7 region, 1.72. So you've had almost a 400 pip move sell-off on the downside, almost, well, 300, 400 pips. So basically quite a substantial sell-off itself. So this is basically what we're looking at with regards to the market. So the market obviously has sold. We've gone back below 1.7. That's the important thing. Almost 600, 600 pip move there. But we are into 200 MA. So that's basically where we are at. We are at the 200 MA. So all the bearish news has been factored in. Now, obviously, the FTSE rally was based on the pretext that the sterling was falling and obviously helping exports, and obviously dovish policy and so on and so forth. But given the news out on Friday, given the fact that GDP data came in stronger, then that obviously bodes well for sterling. And given the fact that sterling's into its 200 MA, the sterling should now get a short covering bounce. And that should obviously, so it's fundamentally backed because of a stronger GDP number, and it's technically backed because of the 200 MA. Is a good short covering opportunity for traders, especially given the sell-off in the currency itself. And obviously geopolitics is certainly a part of that as well. As we all know, sterling can be risk sensitive. So all of that is certainly factored in. So basically sterling is going to rise and the FTSE is going to fall. That's basically what I'm trying to explain to you, because there's an inverse correlation. Okay, why? Because of exports, and obviously given regards to rate hike expectations. Now, Mr. Carney has stated that it's more based on wage inflation. Okay, so Mr. Carney has stated that his focus is on wage inflation. So he's basically playing Yellen's card. Okay, so as you can see, BBC here, Bank of England has halved its forecast for average wage growth, saying it now expects average salaries to rise by 1.25%. The forecast comes with official figures. Blah 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 blah. This is the slowest pace of growth since 2005. Blah 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 blah. Basically, what this chap is trying to do is he's basically put. Well, he started off with forward guidance. Forward guidance got amended to forward guidance, and you had to have forward guidance for forward guidance. And as you know, he's trying to move the goalposts. Okay, so because he's moved the goalposts that many times, he's realised that the best goalpost really is wage inflation, because that's what Miss Yellen's attempting to utilise, and that's a way in which saying, okay, I want to remain dovish, but I don't have any other way to back it up now, and I can't afford to increase interest rates because the economy's not ready yet, etc., etc., etc. He's made to look a fool, just like Miss Yellen's made to look a fool. At least she's tapering. This chap isn't even doing that. So from that perspective, he has. When he initially came, he tried to talk the market into an interest rate rise, and he realised what the impacts of that would be, because nobody could foresee the events in Ukraine obviously hurting the economy. Nobody could see the events of Israel and Palestine hurting the economies, or affecting from a geopolitical standoff. And nobody obviously could foresee the US going back into Iraq. So again, that can hurt the economy as well. So exogenous variable shocks, or exogenous variable, or geopolitical events occur that can hamper your growth model, and then you want to renege. Then obviously it's easy for you to say, okay, let's focus on wage inflation now. Okay, so you change the goalposts constantly. So he's lost his credibility. Basically, he's an imbecile, just like Miss Yellen's an imbecile from my perspective. He doesn't really know exactly what he's doing. I mean, it's all experimental. It's trial and error really. And you don't invest in a good central bank member for him to come out and do trial and error. Okay, so you need to have him have conviction, and he must remain steadfast and stick to his model and his strategy, just like us day traders. I mean, if as I day trade based on intermarket analysis, if I have a good week, then that's good. Yeah, I mean, I could have 3 good weeks, 4 good weeks, I could have 50 good weeks, I could have 56 good weeks, I could have 1 bad week out of the 56. That doesn't mean I change my strategy and I change my methodology in which I trade and which I base my trading decisions on, because I've just had 55 good weeks, or I've had 50 good weeks, or I've had 40 good weeks. Even if I have 10 bad weeks, it's irrelevant. So just because these central bank members they realise that something's obviously being an obstacle in their path, or a certain target's being met, and it jeopardizes their credibility, or it makes them look like a fool, they constantly move the goalposts, which makes them look like even more of a fool. Okay, so they're in a real predicament. Okay, so it basically shows that they don't really understand what they're doing, and they are forecasting just like we are forecasting, and they must admit that they're wrong. Okay, but at least stick to their strategy, or the one that they actually came in with, and not constantly be changing, so that a lot of individuals are indecisive now as to what's going to happen. So yes, he has focused on wage price inflation, so that does make him dovish overall, but he can't argue against data, because as we all know, the economic data did come in stronger on Friday, and UK economic growth was revised up. So if growth is revised up, then as we all know, based on economics, interest rates will rise, wage price inflation will rise itself, and the stock market will go higher. Okay, in the long run. Okay, but at present, given the fact that markets are based on Kool-Aid and love the Kool-Aid, then as soon as we find out interest rates are going to rise, then the stock market will correct and sell off itself. Okay, so how long that sell-off occurs, that's obviously based on the market sentiment and market's thought process, given the fact that it's a goldfish. Okay, so if UK economy grew by 3.2% compared to 3.1, that's really good. Okay, so that's all good overall. Okay, so that means that wage price inflation will come through, because obviously economic growth equals good jobs. Good jobs equals obviously high disposable income. High disposable income will obviously cause people to have more demand than the supply for food. Okay, therefore prices will rise, inflation will rise generally itself. That's what economic growth does, and obviously interest rates will have to go higher in accordance with that. Okay, so given the fact that the market initially expected post Mr. Carney's speech of a lower wage inflation, therefore dovish policy, therefore stock market's higher because sterling will go lower. Now that sterling has obviously sold off quite substantially, as you can see, it's in the 200 MA. Fundamentally, it has strong economic data from Friday to back it up. Up we go on sterling. Okay, sterling goes higher, FTSE goes lower. Full stop. Okay, that's probably the best economic lesson that I can give in such a short space of time. Okay, so now let's focus on the technical picture, because we know higher interest rates, higher sterling, and geopolitics is negative for the FTSE. Okay, so technical chart on a daily basis, topping tail into 61%, 200 MA is held, 20 MA on the verge of crossing over the 200 MA, which is bearish, 50 MA pointing down. Okay, let's have a look at the FTSE 250. FTSE 250 again, topping tail held resistance horizontal resistance, topping tail, down we go. Okay, FTSE 350 again, topping tail, 200 MA, 61% fib, lower lows, lower highs, down we go in the bearish channel. Now we go to our smaller time frames. So smaller time frames we observe, if I go to my FTSE 250 chart, what do you notice here? Let's just go to a 60-minute chart. Always start with the large time frames first. Okay, so what do I see here? Okay, so we had this inverted head and shoulders pattern. Okay, the inverted head and shoulders target was 6530 was a low, 6645, so it's 120 points. 120 points was around 6765. We got to 6745, which is good enough. We more or less hit the inverted head and shoulders target. Head and shoulders target's over. Now the inverted head and shoulders target's over. What do we have here? So we get rid of all this, we get rid of this. All we're interested in is that gap being filled below. So the pattern that I'm going to see, this is what I expect playing out this week, okay, is your head and shoulders pattern. So your left shoulder here, your head obviously has been put in. You're looking for a bear flag, move higher, bang, down we go. So your head is 6745, your neckline is 6675. So you're looking at a 70-point move. So your target is going to be around 6600, okay. Now, obviously, the unfilled gap below is at 6570, so don't be surprised if that gap gets filled, okay? Horizontally, your support level, previous resistance equals support will be in this region here. Okay. Okay. There you go. Okay, so we'll be in this region here. And down we go. Okay, so we've got this pattern here and here and here. Okay, so this is basically where we're at, looking for a move lower, and down we go. Okay, so there we are. Okay, so these are all your levels that you're looking at. Okay, so you've got this level here and this level here, and then obviously projected move down. Okay, so this is basically what we're attempting to expect. Okay, but on the way move down, just watch out for 6650 because that level looks like it's a solid support level. So we'll see exactly what happens. Again, this is all hypothetical, folks. I mean, as we all know, stock market is a stock market. Fundamentals generally do trump technicals because obviously 80-90% of traders out there are fundamental traders. So always bear that in mind. These are just support and resistance levels. Sometimes they get respected, sometimes they don't. They're just guides. So we must work on the sentiment and then the news flow and look at intermarket analysis to gauge where the market's going. If you're going to rely just solely on technicals, I'm sorry, you're not going to be very successful. If you rely on fundamentals only, yes, you will have a high degree of success, but not as much if you were to combine technicals or fundamentals together. Obviously your chance of success increases, but if you combine technicals, fundamentals and intermarket analysis along with the news flow and the sentiment of the market, then obviously your success rate is much higher. That's when you start to hit the 80-90% level, okay, which obviously I've been doing for the last 10 years on the live analysis service. So you're more than welcome to join that and get access to my trades in real time. And obviously this is the analysis that I send in real time via email subsequently after each trade. Okay, so watch out for the head. The head is 6745. Your neckline is around the 6675 region. Obviously that gives you you're looking at around what for 70-point move down, 6600. But my target would be around this 6570 region, the unfilled gap below. Makes logical sense. Okay, so based on technicals, obviously not logical based on fundamentals, but on technicals. Okay, so H&S target, that's basically where we are. We've broken this upward sloping trend line, down we go. And yes, that's basically what we are on 10 minutes, sorry, 60 minutes, 10-minute chart. You have to excuse me, I've got a really nasty flu, which I've had for a few days now. Okay, so basically, you, as we've already discussed, beautiful H&S formation here. So obviously, given the fact that the stock market has certainly moved higher, or US market certainly finished higher on Friday, Miss Yellen's algos, call it what you want. Basically, coming into Friday, your right shoulder will be anywhere around this region. Bang, down we go. So watch out for resistance using your fib retracements. You're looking at around 67, 61. As long as you put a stop loss above, well, I can't tell you, but basically myself, I'm already short from Friday from the 6790 region. My stop loss has been put above the 75% because I don't expect that to be taken out. If it does, as technicians, as we all know, whenever a 75% fib retracement is taken out, then you generally get a double top, and the market can either put in a double top or make a new high, and it continues to short squeeze higher, just like we did on the Nasdaq. If I go to the Nasdaq and show you an example of that, there. Okay, so if I go to a daily chart on the Nasdaq, okay, so as you can see here, this is the projection I expected to play out, given the fact that we had geopolitics dictating, and given the fact that we got tapering concerns, blah blah blah. And what happened? The market obviously got to 75% and thought, bugger that, I'll actually go and close the gap, and I'll actually hit the double top again for no absolute reason other than the fact that Mr. Yellen's algos are in control and they want to knock out every stop there is, because they want to prevent the stock market from going down. Okay, I'm not going to get too much into the manipulation side of things and the fraudulent activity that's undertaken by the Federal Reserve. Okay, that intentionally wants to cause the stock market to go higher, and they want to knock out every short or every bear there is in the book, because they want higher asset prices. But that's basically how the game works. So once you understand that the market's manipulated and it's got to double top, then you can easily short it. Okay, and that's exactly what I did on Friday. I shorted the Nasdaq and I made money from it. So once you understand the dirty tricks and dirty games that are played, then obviously you can use that in your own favour, and your stop losses are always there to protect you. So if you are wrong, who cares? We move on to the next trade. That's day trading. Okay, folks, we're never going to be 100% correct, but we can try and be at least 70, 80, 90% correct. Okay, and that's good enough. That's good enough to make money in the markets. Okay, so here's your pattern. Okay, watch out for that. Like I said, you've got the unfilled gap below, so you've got an unfilled gap or down this region here. We've got a gap here at 6570. That's basically what we're going to focus on. Okay, folks, that's it. No more videos. I must get ready. 11:30 cricket practice now. I need to go do some throwdowns. Big match today. So risk on, risk off, wax on, wax off. Goodbye.